everybody. Mike DeSepoli, Heritage Financial Advisory Group. Welcome to Heritage Insider Weekly for Friday, November 17th, 2023. Hope you're all having a great week. Markets logged another winning week this week. Back to update you on some key economic reports as well as the overall market action. The market continues to show incredible resilience and strength. Momentum continues to build as underinvested investors begin to chase this rally. So the chase is on. I've spoken about this at length over the last couple of weeks, how people will begrudgingly come around to this market. They will chase it higher because ultimately, right, it's very hard for people to buy a dip. Everybody wants to buy a dip, but then the dip comes and analysis paralysis sets in. So many investors that begrudgingly do not believe the market should go higher are starting to wade into the water. So fresh new buyers, fresh new dollars, that's what the market needs to continue its run. We got some validation this week in the sense of economic data, the CPI and PPI, right, our monthly readouts on both consumer and wholesale inflation. Excuse me, let me lower that a little bit. Continuing to show good progress on the inflationary front. This is the data the Fed wants to see. We saw while inflation was flat in October from the prior month, the core CPI hit a two-year low, which we saw coming in at 3.2%. So again, still above the 2% target, but we've come a very long way from that high point of 9.4% CPI, and we're starting to see those deflationary effects in the economy, both from the technology side, from the efficiencies driven by tech, as well as just normal, price elasticity, where prices had gotten very high historically, and now we're coming back more towards the median. So some areas of CPI that were the stickiest on the way up, autos and shelter, are finally starting to show a little bit of weakness. And again, not rooting for weakness in the housing sector, but we want to see prices moderate a little bit. So that was the consumer price index. We saw the following day, let me get him out of here. We saw the following day, the wholesale prices fell by 0.5% for the biggest monthly drop since April of 2020. So consumer side is very important, but the wholesale side equally as important, right? Because these are the big companies that set prices for so many of the goods that we buy. So we saw the index decline by 0.5% for the month. Both of these reports naturally very well received by the market because this type of data, while thankfully we have moved away from this hyper dependency where everybody's hanging on their chair, right, asking about the CPI or PPI when they don't even know what the letters and the acronyms stand for, we've started to move away from that hyper dependency. And at this point, right, we can look away as long as the data doesn't come in worse than feared. Anything that's an overshoot to the upside suggests to the Fed that their job may not be done. It is our belief, that the Fed is done. That they've completed the mission, if you will, right? But the first step of completing a mission is not declaring the mission completed, right? In the Fed's eyes, they want to make sure they want to get some distance between this last rate hike and some months of economic data before they can declare victory. So no victory will be declared from the Fed. However, that does not mean that they will continue. I think this type of data suggests that the Fed is done at this point. Now, a lot of people sitting around just so shocked by the fall in CPI, right? They were shocked by the rise in CPI. They were shocked by the fall in CPI. And you just didn't have to look very far to figure out why CPI went up, inflation went up, and why it's coming back down. This is the consumer price index in blue compared to or charted with M2 money supply, right? The dollars that are in all of our pockets and accounts flowing around the economy, the money that we spend, the money in circulation. And it was really that simple, folks. We had a very big response to the COVID pandemic. The government injected a ton of capital in the economy. You see this massive expansion in the M2 money supply. And what happens when you increase the money supply while keeping goods the same, right? We learned about this in elementary school, supply and demand. More dollars, same amount of goods, price goes up, right? Inflation went up. Then the Fed started removing money from the money supply. And as you get that reduction in M2, you get that fall off in inflation. So no need to overcomplicate it, folks. These are the charts we're watching. If you extrapolate the move in M2, inflation should continue to fall. Now, the game the Fed is playing is just to figure out the right point to start cutting rates. Obviously, these things take time for them to make a move and then have an impact in the economy. So hopefully the Fed realizes that this contraction in M2 money supply has been pretty steep. It actually takes us below the pre-pandemic levels, and at some point this will slow, and with it the trajectory that CPI is on will slow. Let's take a look at the market. Market continues to track our projections very well. It actually, at this point, you have to wonder if the market is taking the more aggressive path up, right? As the market had done for 2 years, thrown a lot of head fakes and a lot of arm twisting along the way. And it was just 2.5 short weeks ago, almost 3 short weeks ago, right? The market was testing the lower band of our projections and immediately found support and shot back higher. So I think it looks like at this point, the market is suggesting to us that it's following the upper of the two paths that we laid out, and that might mean that the path could be more aggressive than we envisioned, right? In a good way, right? So again, we felt we would get to this point sometime in December. Here we are mid-November, so markets are trading ahead of schedule, and that's a good thing. Another thing we're noticing is a major character change in this market. You can see down here, this is our volume in the market, the number of shares traded. We have a lot of green volume bars piling up. That tells you that the appetite for stocks is real. We're also looking at, I won't bore you with this stuff down here, but a lot of our momentum oscillators, gauging momentum in the market, are on the upswing. They're turning higher, and they're nowhere near what we would consider overbought levels, which would mean the market is due for a breather. Even zooming in a little bit here, right? Every little dip in the market continues to be bought. So that's a good sign. That means that sellers really don't have much energy at these levels, and buyers have a very strong appetite, as we said, as underperforming funds and fund managers who have bet against the market all year now swing around to the side of being bullish and chase performance into year end. So we expect that the market obviously has come a long way. I don't expect that we're going to get any sharp pullbacks off this. We may get some sideways consolidation, but the stage is set for the year-end rally to continue. Now let's take a look at a couple other data points. Now I just wanted to come back to this. We brought this up a couple weeks ago. People tend to overcomplicate the stock market. It's never easy. That's certainly not what I'm saying, but the clues are all around us, folks. You just have to dig through the data to find them. I shared this chart 3 weeks ago on October 27th, and we had the compiled data for the average year of the S&P 500. All the years from 1950 through current, the average performance for the stock market. And what did we note at that time was that the stock market tends to bottom after that August, September, October malaise. It tends to bottom on October 27th and rallies for the remainder of the year. Well, let's go back to the S&P for a second. Do we know? You want to take a guess? When did this market bottom? That's right, October 27th. No need to overcomplicate it, folks. Again, seasonality is not the only factor that drives markets, but this is an important one. Yet many people missed it because they were scared about the price action they were seeing. That's why you have us to sift through the noise and find the facts and data that will move markets. So again, we'll revisit this again in the future, but seasonality playing very well. Let's take another look at the market. This is a different chart. This is all data compiled from when markets are up 10% or higher through June. This year's tracking very, very closely to this data, right? You get that big move through the end of June. You get a very weak and choppy summer into the end of October, and then markets bottom and rally for the year. So again, average of all years is in orange. The 2023 is in green, tracking very closely, right? Finding that bottom on October 27th, and it appears the chase is on for the year-end rally. Something else I wanted to cover. Let me see if I could make this a little larger. Okay, now that everybody has fallen back in love with technology stocks, right? That group of stocks that everybody hated last year, because that's how fickle investing can be sometimes, right? Something works, people love it. Then for 1 year it doesn't work and everybody abandons ship. Now people are tripping over themselves to buy tech stocks again, and we are unemotional about this topic. Tech stocks are important. They need to be owned. They're not the only thing you should own, but they have a place in every portfolio. The next industrial revolution in this country is here and now, and it is in tech and AI and the likes. But I wanted to share this to show you this is the price you pay to own tech, right? Here's the last decade, the S&P 500 in black, the technology index in blue, right? The S&P 500 over the last decade up 200%, 20% a year. Nobody's going to complain about that, right? Any investor would sign up for that. But look at the difference in the outperformance of the technology sector, up 512% over that same period, outperforming the S&P by 300%. Staggering numbers, okay? That sounds great, but what's the catch? There is no catch other than the price that you pay for this outperformance is more volatility, right? So look at last year, a much deeper pullback in tech, right? The S&P pulled back 25%. Some of these tech indexes pulled back 50%. And it was at this point right here that uninformed investors said, tech is broken, right? It's broken. It can't be owned because some old guy on television who's angry and constantly yelling told me that it can't be owned. All right, investing is not done like that, and it's about looking at the trend over the longer term to identify the things in the market that will give you the best chance to succeed and make money in excess of the market. So again, let's not forget, tech is reigning supreme right now. There will be a time again in the future when it's not performing as well. Let's not forget why we own it and what it has done for us. And again, this type of outperformance, we will accept the volatility that comes with it to get this type of results for our clients. So let's take a look, fear and greed. Let's check on sentiment, right? We've just had a tremendous rally, and basically we got the gauge to go from extreme fear slightly into greed. Okay, slightly into greed. Greed at 58 does not concern me. I know what you guys know what I think. When we get into extreme greed, it'll be time for the markets to cool off. This tells us the market still has some room to run, right? We do not have a lot of believers. Everybody has not piled in or jumped back into the pool with both feet. And until or unless that happens, this market has room to move higher as people continue to allocate capital to it. Also, let's not forget, year-end sees a lot of money flows into the market. Pensions, endowments, 401k savers, right? A lot of year-end contributions come into the market, as well as a lot of treasury bonds that are maturing from a year ago, from 2 years ago, from 3 years ago. Some investors might buy more bonds, but others might all of a sudden have an appetite for the stock market again, right? It's funny how that works. So that's something to keep an eye on. And last, I want to end with our some of our market metrics and internal statistics. Let me zoom this in. Okay, we talk a lot about under the hood of the market. I'm just going to highlight a couple of these things down here to display that to you. So you look at the market today, right? Great week, not much going on today. Dow up a point, NASDAQ up 11, S&P up 5, right? So gains, but not much in gains. But this is when we talk about under the hood of the market, this is what I want to convey to you. This is the advanced decline in the market, right? Looking at stocks in the market, how many are advancing today and how many are declining. Notice the extremely or exceedingly bullish readings on these indicators, right? 72% of stocks advancing today versus only 24% declining. 70% of stocks making new highs today versus only 30% making new lows. And how many stocks are above their moving average? 67% to 33%. These are the type of numbers that you would expect to see with a big rally going on across the board. So this tells us there's a lot of strength under the hood of this market. It may carry us into next week where you actually get the gratification, right? We call it delayed gratification. Sometimes we spot these types of trends and tells popping up under the hood of this market. So let's look to see what the markets do next week. Wouldn't surprise me to see some continued strength and follow through. And then let me just zoom back out so we could take a look at our heat map, right, for the week. Let's see how we did performance-wise. A very solid week for markets. You're seeing gains in the right place. Walmart, the one lone holdout here, they had not great earnings yesterday. It said there's signs of consumer slowing a little bit. So they got hit over the head this week. But other than them and Cisco, it's hard to find much red on this chart. So we don't own either of those outright. We're very happy with where the performance continues to show itself. You're seeing tech lead the way. You're seeing NVIDIA. You're seeing Google, Amazon. When the largest companies in the world are leading the way, they are telling you where the market is going. It is our job to listen. So we hope you guys enjoyed this video. As always, if you have any questions, feel free to reach out to us. We're always here to talk to you about anything that's on your mind. We hope you have a great day and a great weekend. Now, next week is a shortened trading week. We have Thanksgiving on Thursday. So we'll see if we're going to be able to get a video out next week with some of the shortened activity. For any of you, if I don't speak to you beforehand, we hope you have a happy Thanksgiving with friends and family. We are very thankful for you and the opportunity to work for you, to serve you. We appreciate, that opportunity, and it's something that we never take for granted. We really love what we do, and I'm thankful that I get to do this every day. So we hope you guys have a great weekend. We're here if you need us, and we'll see you back on the next Heritage Insider Weekly.